Welcome to this month's vlog on matters superannuation, in which we'll have a look at a number of contribution issues that are likely to impact taxpayers and advisors over the next 12-month period. One important consideration is the possibility that contribution caps may increase from 1 July 2024 if wages growth increases over the remaining measurement timeframe, which certainly seems possible at this stage. We may then possibly see the concessional contributions cap raised to $30,000 and the non-concessional contributions cap raised to $120,000, thus potentially allowing a bring forward arrangement of up to $360,000 if entered into on or after 1 July 2024. The total superannuation balance threshold may also change subject to the rate of change of inflation as measured by the CPI, a different measure to that applied to contribution caps. Of potentially greater importance for advisors will be the implementation of the Stage 3 tax cuts, which have been legislated to commence on 1 July 2024, subject to any legislative amendment that may be introduced by the government over the next 9 months or so. Under the legislated tax changes, we will lose altogether the 37% tax tier, which currently commences at $120,000 and ceases at $180,000, at which point, of course, the top marginal tax rate of 45% is incurred. Of course, we also need to add Medicare levy in addition to these tax rates. Under the Stage 3 tax cuts, there will be a 30% marginal tax rate applicable from $45,001 up to $200,000, which leads to some questions about the effectiveness of deductible contribution strategies for those on higher incomes. Excluding the impact of Div 293 tax on calculations where appropriate, a taxpayer who's currently on $150,000 per annum will effectively gain an arbitrage of 24%, representing the difference between the superannuation fund tax rate of 15% and their marginal tax rate of 37% plus 2% Medicare levy. After the implementation of the Stage 3 tax cuts, this arbitrage will reduce to 15% on the same income level after 1 July 2024. The situation is even worse for taxpayers who are currently in receipt of taxable income between $180,000 and $200,000, as the arbitrage will effectively go down from 32% down to 15% as a result of the changes in the tax scales. This gives rise to a number of thoughts with respect to contribution strategies that may be applicable for some of our clients. We should also note that the catch-up unused concessional contribution strategy will, for the first time, need to be considered in light of the 5-year measurement period. This current financial year is the last year in which unused concessional contribution amounts from 2018-19 can be utilised. This is a use it or lose it scenario. For those clients who are members of self-managed superannuation funds, this would also be a perfect opportunity to consider a deferred concessional contribution strategy under certain circumstances. In order for the deferred contribution strategy to work, the trust deed of the SMSF must allow for the strategy, and the appropriate documentation needs to be in place, such as resolutions and the notice of intent to claim a deduction. Importantly, the NTLG committee, in their June 2012 statement, advised that a member cannot defer part of a contribution, and therefore, if advisors and members wish to take advantage of the opportunity, at least 2 contributions during the year must be made, with the latter contribution being made in June. The deferred contribution strategy requires that additional contribution to be made in June, which, rather than being immediately allocated to the member account, is held effectively in reserve until the allocation is made within the first 28 days of July. The advantage is that a tax deduction can be claimed for the contribution in the current financial year at the current marginal tax rates of the member, rather than being a contribution being treated potentially less favourably under the Stage 3 tax cuts scenario. It's also important to note that a deferred contribution strategy almost certainly will not be able to be taken place in a retail or industry fund. As always, when assessing the capacity to access the unused concessional contributions catch-up provisions, it is essential that the client accesses their MyGov ATO facility or talks to their tax agent to determine the precise amount able to be utilised under the strategy. The deferred contribution strategy is a little more complex, and we would be pleased to assist in determining whether it be worthwhile and possible for any of your clients to take advantage of this. Don't forget too that all personal contributions made to a superannuation fund are treated as non-concessional contributions until such time as further documentation is received by the trustee, which would change the nature of the contribution. Here we refer to things like the notice of intent to claim a deduction, notification of a downsizer contribution, or notification of a CGT contribution under the Small Business CGT relief. In addition, the work test, we must note, is not of interest anymore to fund auditors, as it is the ATO which determines eligibility, and this may provide further complications in determining the capacity for your clients to be able to claim a deduction. Given the potential changes to tax scales and the runoff of entitlements under the unused concessional contribution catch-up rules, we are now in a position in which we have a number of touch points which could be considered with clients prior to 30 June. As always, we're here to help. Thanks very much.